Welcome to the Broken Pie Chart Podcast, episode 317. I'm your host, Derek Moore. All right, Jay will be back maybe next week or two, potentially. We haven't confirmed that yet. But another Jay was back, and that's Jay Powell. The Federal Reserve did nothing, said something. People liked it. The market rallied towards 5,700 in the S&P. Kind of hit the old high, or the most recent high, I shouldn't say the old high, and they came back down. It was actually the S&P posted its best Fed day since July, and this was in Bloomberg, according to Bloomberg S&P performance during the Fed decisions. And it's only, I'm just looking back, so this one was really good. It's right around 1% up for the day. And yeah, I mean, it was like a 1.5 back in, according to this, July of 23. There was another up day. Let's see when this one was. But I got to be honest with you. I mean, the last two have been down days. We had a 3% down day. We had a 0.5% down day. So the market seemed to take whatever Jay Powell was selling in good regard. And they announced the dot plots, the summary of economic projections. That's where, you know, everybody on the Federal Reserve, the Board of Governors, they sort of say, hey, I think inflation's going to be this over the next whatever number of months. I think that GDP is going to be this, unemployment, and here's my interest rate projection. And the interest rate projections are kind of what everybody is most interested in. And, you know, I always warn people, you really shouldn't look at these because it's never right. It's never right. Go back 5 years ago, go back 10 years ago, go back March of 2009, 2013, 2014, whatever period you look at, whatever the Fed says their economic projections are going to be in over the next year, next 2 years, they're always different. And the part of the reason why that is they make their projections, the new information comes in, and then they come in with new projections. So I sort of caution people to think, okay, now they're saying 3 interest rate cuts over the next, the median is 3 interest rate cuts by the end of 2025. And then next time they do the projections, it'll be something different. They'll say, no, now we have X number of cuts. So what does this really mean? Well, again, don't take too much umbrage in what they're saying, but let's examine it for a second. If you use something like the CME FedWatch tool, I'll put a link in it in the show notes. If not, just Google CME FedWatch. You can pull it up. And if I look, what is it saying? Well, right now, the Fed funds rate is 4.25, 4.5. We know they've already lowered Fed funds by 100 basis points, right? So they have nothing at the May 7th. There's like next to no probability they'll do anything. Now, if you look at, for example, the SOFR futures, which is the overnight funding rate, well, it says minus 25 basis points at the June 18th meeting, and that would bring it to 4.25. Nothing in July. Fed funds say 3.75 to 4% in September. That would be another 25 basis point cut. And then a 25 basis point in December, which would bring the rate to 3.5 to 3.75, 3.5 to 3.75. So is this what's going to happen? Probably not. Probably not, because the expectations change. And who knows? So, you look at this and you say, all right, so why are they saying that? Well, one is that if you look at the projections for year-end 2025, that's this year, in case you are not aware or you forgot, they say the unemployment rate is going to be 4.4. The December projection was 4.3. So that ticked up by 0.1. Unemployment rate in 26, and who the heck knows what's going to happen in 26, 4.3%, 4.3%, 27. Okay, great. Good luck on that, kind of holding exactly how they say. Change in real GDP. Real means after adjusted for inflation as opposed to nominal GDP. Well, this one, they actually lowered it by 0.4 from December, a growth rate projection of 2.1 for 2025 to only 1.7. And in fact, they lowered their growth projections for 26 and 27. PCE inflation, they increased their inflation sort of expectation and went from 2.5 to 2.7 for 2025. And then core PCE went from 2.5 to 2.8. So they actually have employment, their expectation on the dot plot went up by a little bit. GDP went down, inflation went up, and they're saying the median Fed funds rate should be right around 3.9. That did not change from the end of December. What's interesting is that the market's interpretation is now different. And I think at the end of December, maybe there was one cut priced in based upon the Fed funds futures. Now it's 3. All right, whatever. And I say whatever because this is going to change, and people will go on TV and they'll say, well, the market's only pricing in 3 cuts. Market's pricing in 1 cut. Remember the market was going to price in 7 cuts? That didn't happen. So inflation is going in sort of the rate of change is not 2%, but as Jay and I have both talked about, it's very rarely right around 2%. It's, in fact, most of the times it's not exactly 2% or within 25 basis points of 2%. We also hear a lot of things about the economy is slowing, the economy is getting worse. One of the things that I like to look at is something called the LEI, or the Leading Economic Index. Is this guaranteeing, or is this spot on 100%? It knows when a recession is coming? No, of course not. And the Leading Economic Index, basically, you think leading or coincidental or lagging. So leading is things, hey, when we see these, that gives us a good idea what's coming. And there's financial factors like stock prices. Why they put stock prices in a leading economic indicator, I don't know. It's not my index. But stocks are off the highs. So that's probably one of the reasons why in February, the year over year ticked down a little bit. And I think in February, it ticked down. Oh, I just had it here. I'm scrolling over here. And I think it was like minus 3.1, minus 3.1, minus 3.2 maybe. But all right, so what's in the leading economic index for the U.S.? It's average weekly hours in manufacturing. Okay. Average weekly initial claims for unemployment insurance. All right. Very good. Manufacturers' new orders for consumer goods and materials. The ISM index of orders. A couple more here. Manufacturers' new orders for non-defense capital goods, excluding aircraft orders. Okay. Building permits for new private housing, the S&P, leading credit index, interest rate spread, that's 10-year Treasury bonds less Fed funds rate, right? Average consumer expectations for business conditions. And be careful on these, these sentiment indicators. I think it's very, very, unfortunately, it's like, if you ask Democrats, the world is falling apart. Republicans are the opposite. Independents are where independents are. And it actually flipped from where it was when Biden took over. So I'm just going to say it again. These are becoming useless. There's also coincident in economic indicators, and that's payroll, employment, personal income less transfer payments. So personal income less transfer payments is a fancy way for saying money that people make from working at a job versus, let's say, I don't know, Social Security or unemployment or other government handouts, stipends, those types of things. So why is this leading economic indicator interesting? Well, it's interesting because it has been trending up. And I will tell you, going back to 2000, when it gives a recession warning versus just a warning signal, and one is a diffusion index and one is when it gets to minus 4.2, then it actually gives a recession warning as well when the diffusion index. All right, don't worry about all that stuff. But it fell below the recession signal in 22. And as far as I know, the National Bureau of Economic Research has not declared that we had a recession during that time. It bottomed probably in 23, and I'm just eyeballing this kind of like, I don't know, minus 7.5. So it's still negative. It's probably, let me see if it will tell me what this is here. Where is it? All right, it'll come to me in a second. Less than half the rate of decline. All right, so anyway, it is still, it's not trending back down. It sort of came back down in the beginning of 24. This is released monthly. But, is the economy absolutely falling apart? I don't know. I mean, remember, you sort of look at normally what is the, I forget who has this. They call it the HOPE, housing orders, profits, and employment. And usually employment's the last thing to go. Housing, sometimes you see weakness there. I've seen some people, and I'm not an expert in the real estate market, tell me that prices have still been pretty stable. And inventory is going up, but it's not necessarily, we're not really seeing weakness in housing per se. And when you look at something like the LEI, the leading economic index, the headline was its 6-month growth rate remained on an upward trend, but weakness among the components triggered the warning signal. So there's a warning signal, and the warning signal is based upon, it doesn't matter. This is too wonky for a podcast, but so I'll put a link in the show notes to it. You can check it out. All right. Other stuff that I want to get into is people are still really bearish, very bearish. If you look at something like the AAII Bull Bear Spread, I mean, people are very bearish. And AAII stands for American Association of Individual Investors. I don't know who is a member of this, how many people there are. There's some organization, they get a survey, they fill it out. Okay. And typically when you see this level of bearishness, that can be a contrarian indicator, meaning when everyone's like, hey, get me out, I don't care, that's somewhat of a positive sign. Does that mean we've seen the lows for the markets? I don't know. That's why we buy and hedge. And that's why we try and put things in portfolios, whether it's hedges or buffers, to take some of the worry out of this and take some of the need to try and time the market. If you look at the VIX Index and then you look at the VIX Futures, remember the VIX Futures where people can actually trade, the VIX Index, they call it the spot index. That's the one you see on CNBC. You can't trade that. But the spot index for the VIX is still above the VIX future a month out. And after, besides, let's say, the spot VIX, the rest of the months are, a normal VIX curve, meaning the front months are lower than the back months. But you've got, basically you've got the current spot VIX higher than the next couple months of VIX futures. And so what that's telling me is that the market, or at least the options market based upon the VIX, is seeing this volatility that we're experiencing now. They're not pricing it in past a certain point. I did see a chart, and somebody had drawn the line of, I forget who this was. Might have been on Bloomberg, but it was a chart that kind of drew in where April 2nd is, and April 2nd is when some other tariffs are coming in. They may come in, they may not come in. We'll see. And it seems like the analysis, I might have seen this in Bloomberg, on the Bloomberg terminal, that there's the expectation is we're going to have volatility until April 2nd, and then the market's not pricing that anymore, because then it will be a known thing. Yeah, I don't know. I mean, I've talked about tariffs a little bit. My general view is I'd rather there be no tariffs whatsoever, and countries should make the stuff that's most economic for them to make. And I've always said I don't like the fact that there are sugar tariffs in the U.S., meaning we have production quotas where we'll only allow a certain amount of imports. And after we reach that, then I forget what's 100% or 200%. Other countries do this. But anyway, getting back to the VIX, this is kind of one of the thoughts right now. This will probably change in a week or a couple, even Monday, by the time, if you're listening to this on your morning commute, although this will be out on Sunday. So I think the main point there is that it feels like, and it feels a little bit like this patch we've had, or this volatility, it seems like the market is sort of settling in. What is interesting too is that, and I saw this on Bespoke, and they had a note on Twitter. It said, since 2005, there have been 17 periods when the S&P was down from the open to close 14 times in 20 days. 3 of those have been in the last year. So that's basically like, 20 years of trading. And it's true. I mean, if you look and you see, we've had a lot of these days where the market maybe opens higher and then can't hold the open and then kind of makes new lows. We've had 2 Fridays. Do we have the Fridays? Oh, now I can't remember. But I feel like there's been a couple days where it opened and it rallied into the close. The Fed day looked like it was going to be that, but then it kind of eased off after matching that right around that 5,700. But one of the things, Kevin Gordon had tweeted this out, and I've been saying it too, that a lot of this is multiple contraction, thinking about what are earnings expectations, and then how many times those future earnings expectations is the market trading. Kevin Gordon mentioned the sell-off in tech, quoting him, has essentially been all multiple contraction thus far. Forward 12-month EPS estimates made a new high yesterday. So that's, what are the analysts expecting over the next 12 months? And then thinking about the price. And the reason why I keep coming back to this is you can have an earnings recession. You can have earnings estimates. So you can have earnings recession, where that is reported earnings are down year over year, and usually down year over year for a few quarters. So we don't have that yet. And when I say yet, I mean, we don't have it. I mean, I don't know whether that's coming or not coming. But the other thing you can have is you can have earnings estimates, future earnings estimates coming down. So far, and as Kevin Gordon pointed out, looking at a chart, looks like he used Bloomberg for this, and the S&P 500 information technology sector, I mean, the forward 12-month keeps going up and up and up. That's different than kind of mid-22, where the forward 12-month estimates in mid-20, they sort of peaked in mid-22, and then they were lower. And they didn't trough out until, I'd say, midway or almost midway in 2023. And ever since then, they've been kind of up and to the right. So remember, multiple contraction means, so, let's just dumb it down for a second. Let's say you're trading at, I guess we can use, the actual S&Ps. So the S&P closed at 56.67.56. Okay, I'm just going to round this up, and I'm going to say 56.68. And so if we have, let's say the 12-month forward S&P 500 earnings per share is 270. So I'm just going to round it to 270. Well, if it's trading at 56.68 divided by 270, all right, we're trading 20.99. Let's just call it 21. So keep in mind the 21. Well, let's say earnings estimates over the next 12 months, analysts drop them to 260. Well, if we stay at the same multiple, 260 times 21 brings us to 54.60. You see how that works? And a change in the earnings, I mean, sure, that would, assuming we stay at the same multiple. The worst case would be we drop the multiple and drop the earnings. Let's say we went to a 19.5 multiple times 260. That brings you to 5,070. All right. So I keep getting back to this because it's really important. And when you look at, I'm very interested in not only over periods of decades, but also from year to year. What was the attribution for markets? What was the source of return? Was it dividends? Was it share buybacks? Because remember, if you reduce the share count, the same earnings, the earnings per share go up because you have less shares. Was it multiple expansion or contraction? Was it earnings going up and down? And then when you think about earnings, the components there are, what are sales? Did it go up or down? Did margins go up or down? And then that trails down to the earnings per share line or net income line. So these are very interesting things for me to take a look at. And so far, we've seen multiple contraction. We have not seen where earnings estimates are coming down. So another chart, I think it was Lizanne Saunders at Schwab had put this out. And this is a Bloomberg chart. And it's a chart of different components. So the S&P 500, the Bloomberg Magnificent 7 price return index, and the S&P equal weighted index since September 16th. You know what happened on September 16th? Wasn't that the first rate cut by the Fed? And when you look at this, what you find is that the equal weighted index is now slightly lower. If imagine the price for this was 100 and now it's 99.4. So, basically it's flat. It's basically flat. And same thing, it's the S&P index is now slightly positive since the first rate cut. The biggest line in this chart, the biggest change on this is the Mag 7. The Mag 7 expanded remember they made that all-time high, I think it was December 17th. December 17th or December 19th, I forget, because then the all-time high for the S&P 500, at least recently, was February 17th or 19th. Now I can't remember it. What you see is the Mag 7 really rallied and it's come all the way back down. It's now only up 4.3%. At one point, I think it was up close to 30% at the highs. So the Mag 7's come down. Equal weight is basically flat. The S&P 500 index is essentially flat. And I wonder too, I feel like sometimes when you have, it took a pretty circuitous route to get here. But yeah, markets kind of flat. And I think that frustrates people. The other thing I keep bringing up too is the fact that drawdowns are not only they normal, but they happen all the time. So as of Friday, the drawdown from the all-time high, let's see. Yep. So the drawdown from the all-time high in February was minus 10.1%. I think now we're back to, what are we back to? Like minus 4% for the year, something like that. I'd have to take a look. And then you look, 2024, the drawdown was 8.5%. The market wound up closing up 25% to the positive. 23 minus 10.3%. Well, market closed up 26.3. 22 was the bear market year. Minus 25.4% drawdown, max drawdown, closed minus 18.1. But you go back, 2020 was the crazy year, but even 2021, minus 5.2% was the drawdown, plus 28.7. If you look at the Intra Year Drawdown and think about, imagine somebody panicked at all of these Intra Year Drawdowns. A lot of these years, I don't know what's going to happen going forward, but a lot of these years are positive. And it really lends itself to say, why not? Everyone's situation is different, but why not, stay in the markets, maybe be hedged. All right. The other thing I wanted to comment on, somebody had sent me a copy of Cliff Asness from AQR had written a perspective called Rebuffed, a closer look at options-based strategies. And in it, he's kind of negative on this stuff. And what he did, and I quote, he said, out of the 624, so by the way, buffered funds or buffered ETFs, or, we run a lot of buffered strategies, and there's different types of strategies. There's some that aim to, be more like, so we run something called ZBIG Treasury, where essentially you use the Treasury interest to buy call options. And in theory, quote unquote, if you hold a Treasury bond, you're basically like, okay, between now and maturity, here's the interest that I'll receive based upon the coupon or any appreciation or depreciation to par value. Okay, assuming U.S. Treasuries don't default. And you say, okay, well, let me take some of that, or let me take that interest and put it towards buying a call option that notionally or synthetically owns the market. Okay, that's a quote unquote very conservative one. There's other ones where we'll do a construct where we aim to have equity losses buffered for the first 25%. And there's different pieces that are in there. We use a little bit of short duration, high yield. And the reason why I bring this up is because many of those are not meant to beat the market. In fact, we're pretty clear that hedged equity strategy shouldn't beat the market in up years. It shouldn't. You're giving up something to have protection in a portfolio. There's no unicorn strategy. There's no free lunch. Like, you shouldn't expect to have hedges in a portfolio and outperform the market in up years. In down years, if you have a buffer, if you have a hedge, maybe a floor in a portfolio, and the market's down by a lot, you should expect a lot of these strategies to outperform. So I have a little bit, and I'll be honest with you, I've read this, I think once, I read it over again, and I said, well, should I talk about this? And I said, why not? So he asked, have options-based strategies delivered? And he says, the conventional wisdom, or at least the conventional sales pitches, these strategies provide an investor with equity market participation, but with less of the downside. It says, in exchange for some of this downside protection, these strategies should be expected to trail the broad market. Yes. That's right. So he said, let's see how they did. Of the 624 funds in these option-related Morningstar categories, we look at the 99 that have histories going back to 2020. For these 99 funds, we asked two questions. Did the cumulative returns exceed that of passive U.S. equities, proxied by the S&P 500 index? Were their worst drawdowns less severe than that of passive U.S. equities? Okay. So when did this say they went back? Okay. So January 2020. All right. And when did this, when's the end date for this? I want to try and see that too. I don't know if they, okay. It looks like they have a chart, January 1st, 2020 to January 31st, 2025. Okay. So then it says, did their cumulative returns exceed that of passive U.S. like the S&P 500? Were their worst drawdowns less severe than that of passive U.S. equities? And he said the answer to question number one is no. Every one of these funds delivered lower returns than the equity market. For question two, we have good news. Most, 86% of these funds had smaller drawdowns than the market. And, he gets into, some other things here. If I remember, I'll put a link to it. My problem with this is that, sometimes you lop all of these, like, I don't know what all was contained in their analysis, these 99 funds. How were they constructed? Were they saying, we'll limit the upside to 5% and limit the downside to 5%? Like, I don't really like the idea that they're using all of these, this is kind of broad. I'll try and dig into this. Maybe I can find out. And to me, I think I don't like the way this is argued, because I can tell you I'm just thinking of our buffered, our separately managed account, our ZBIGs, say good buffer and index growth strategies. I mean, we've got ZBIG Treasury Income. Okay, those are two. ZBIG IRA. We've got ZBIG Standard. We got ZBIG Leverage. I mean, we have 5 different ones. So imagine you just put all those against the S&P 500. That wouldn't make sense. Those are designed to do different things. And also, like I said, if you want to have hedges or buffers, most times you have to give something up. And that's fine. See, for many investors, and I think this is, so I'll set aside the Cliff Asness, the AQR piece for a second. And I promise I'll dig deeper into that. But I think a lot of people make the mistake, and I see this on YouTube, I see this on TV, they compare things to the S&P 500. And they say, if you don't beat the S&P 500, some reason that is flawed or it's a failed investment. And I actually think that's not true. Remember, someone right near retirement, not just someone who's going to retire in 2 years and has done pretty well. They've got a couple $1 million, but they need more growth. And they need more growth because they say, look at my expenses. Average estimate of life expectancy is going up, or they have a couple kids that are going to be going to college, for whatever reason. And they say, I need a little bit more growth because I want the money to last, or I want a certain lifestyle that I want to maintain in retirement. And one of the benefits of having hedged equity strategies is trying for growth, not necessarily trying to beat the market. But if you can sleep a little better at night, I should say potentially sleep a little better at night, and you're okay with giving up some of the upside because you have protection in the portfolio, isn't that something that's good? Or would you say, unless I beat the market, I'm not in the right strategy? Someone right around retirement or right start of retirement probably shouldn't be trying to beat the market, or probably shouldn't be in 100% equities. And so I think sometimes looking, did it beat the market or not? Do you have a portfolio that you can live with? Do you have a portfolio that's going to try and get you what you need, what you want, and what your goals are? So I kind of went off on a little bit of a tangent here. It's not necessarily related to the article I just read. I have my own issues with how that's presented. I'd love to know a little more about it. I'd be open to seeing that. But I think it's a good lesson for everybody. Like, the goal should not be necessarily to beat the market. The goal should be to get what you need. Like, what is it you're trying to accomplish? And if you wind up having a portfolio that lets you do X, Y, and Z, you want to retire this date, you want to maintain this sort of lifestyle, you want to have the money last. Like, if these are all things, that is your goal, not the goal to beat the market. And I don't think this thing of, I didn't beat the market. You weren't trying to. You're trying to grow the assets, maintain the assets, or get what you need, what you want, and hopefully what you want to accomplish. So, all right, that's that. All right. Hopefully that's helpful though. Like, just, we've been doing this for a long time. And one of the things when we meet with new clients, and I know advisors do this too, it's like, what is it you're trying to do? What is it you're trying to accomplish? Like, think about it. We have, you can go to our ZegaInvestments.com, and there's a growth simulator that's on our website. It's free. You don't have to put in your email. You don't have to put anything in. We don't capture the information. You can just use it. We put it out there for free. And you can go on there and you can put in your current assets, how much you're putting away each year. You can put in your estimated expenses in year one of retirement. We'll inflation adjust everything. You can change the rate of inflation. We'll do some estimates of what you're going to get in Social Security. And you can put in like future one-time expenses or windfalls. Maybe you have an uncle who is going to leave you $10 million. Wouldn't that be nice? And you can sit there and play around with it. And you can play around with the estimated annualized return that you think you might get. You can estimate it hypothetically, right? And you can see the growth of your assets, assuming for needing money in retirement, getting Social Security, doing all those things. That's what matters, not necessarily absolutely beating the market. Because if you wanted to beat the market, you can try and do that. But if you want to try and get what you want and what you need, that's a different story. All right, recommendations this week. All right, it was kind of a busy week, so I got to be honest with you. I didn't really watch anything new, but I'm going to give a pre-recommendation. And I'm not saying this is good or bad, but I turned on Apple TV Plus, and there's a movie called The Gorge, Gorge, with Miles Teller. And Miles Teller, and I think Anya Taylor-Joy, wasn't she in the Queen's Gambit, the chess movie? I think she was in that. And it kind of looks interesting to me. I don't know if it's going to be any good, but it's a movie. And you've heard me say this before. I kind of like when it's just a movie and I don't have to invest in 7 episodes. And then is it a one and done season or is it coming back? So The Gorge on Apple TV Plus, if you have that. It's, Sigourney Weaver is in it too. I don't think we've seen her in anything in a while. So I'm going to check that. That's a pre-recommendation. I'm going to watch it. And next week, I'll tell you whether I think it's any good. And remember, send me emails. We like getting emails. Derek.moore@zegainvestments.com. That's DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly, .com. We like getting emails. If you have a chance, and you want to rate us 5 stars on Spotify or Apple or wherever you get your podcast, do that too. But more often, more than that, share the episode. Send a link to someone that you know who might enjoy the episodes. And we like getting emails because sometimes we get show topic ideas or questions, and we'll read those on the show. So I didn't get any emails till last week. I think, what was it, 2 weeks ago or a week ago, we did listener questions. So I'm ready to get a couple of those and queue those up, and we'll hopefully answer those next time. So send emails. 5 stars. If you're not going to raise 5 stars, don't do anything. We don't want any ratings that aren't 5 stars. And share the episode if you can. All right. Hang in there, everyone. Remember, Intra Year Drawdowns are normal. They happen all the time, as Peter Lynch says. Once every 2 years, you get a 10% drawdown. And of 94 years going to through 1994, over something like 93 years of history, it happened 50 times. I promised I'd do the math since 1994. I haven't done that yet. I owe you that one. But we'll see you next week. Send emails. Take care.